at the numbers, right? I mean, if Bitcoin were to become the global reserve currency, I'm not saying it will or won't, but if it were, that's an $83 trillion market. Real estate alone, if we just tokenize real estate, that's 200 trillion. If we take all of private assets, private companies, private equity, real estate assets, $700 trillion. So Nikhil's point about millions of security tokens or digital securities are going to happen. And this is going to be a tsunami of activity from the analog world to the digital world. Huge opportunity.
So here's the way I think the tsunami transpires. So right now we've got phase 0.1 where there are PDFs on a blockchain, right? And that's really simple and that's nice. And there is this idea that there's this magical pool of liquidity that's going to come. That's not there. That doesn't exist. But here's where I'd like to challenge everyone here that has an investment hat on, is think of all of the investments you make as an expression of an investment idea, right? Everything you look at, whether it's, going to get your breakfast or it's an investment in a stock, as what idea does that investment thesis create? And security tokens create a whole new genre that never existed before. So for example, if you wanted to buy a bunch of real estate, you can go to get a REIT. If you think that in Manhattan, there's a part of Manhattan called Soho, and if you think the real estate in Soho is going to be worth a lot more in the future, there's nothing for you to buy. There's no way to express that idea. In fact, maybe you think, Reykjavik is going to do better than San Francisco, and there's no way to express that investment idea, as an example. But if you were to have all of the real estate in New York, in San Francisco, and Reykjavik as different security tokens, you could break them down and build them, rebuild them as whole new investment ideas. And now you can think, okay, maybe this isn't just turning traditional securities into smaller fractionalized pieces. Maybe I want to invest in impressionist paintings versus realism or abstract. Yeah, and these kinds of ideas don't exist yet.
No, it's like calling the internet a fancy phone, right? We have a supercomputer in our pocket, right? The same thing is when we went from snail mail, right? I wrote a letter, I put it in an envelope, I sent it off, you got it, 3 days later I got it back, took a week to correspond. I couldn't make copies very easily, I couldn't cut and paste and copy and edit. When you digitized that information through the internet, it was transformational. To all your points, we could take a letter and divide it into pieces, send those pieces to different people. The same thing is true with value. What the Internet of Value or the trust net's going to do is transformational. I mean, this is so much bigger than people see, and to your point, it's point one. We're just in the warm-ups. The game hasn't even started yet.
So, Nikhil, as you think about this being point one of the key leads on deploying capital for the NYCQ fund, you talked about the idea of being able to express new investments. How do you think about investing in this ecosystem at point one to facilitate that in the future?
Got it. So the big risk that someone runs right now is investing too early, right? And so if you notice, what I chatted about before was ideas and picks and shovels based in businesses and subsectors that are already revenue generating, that are already proven within the crypto sphere, right? Because frankly, most venture funds are really, really, really long. They take way too long in order to get liquid. I don't like that. Right. I like cash on cash returns, and I like to make money in a reasonable amount of time. And I think that within crypto, you don't have to wait 10 years in order to make a decent return. So to be more specific, some of the things that I'm excited by are answers to the question, no matter what protocol is successful, what businesses will be needed in order for those to be successful, right? So is that smart contract auditing, right? That seems like it might be helpful. Anything security related around blockchain analyses. It's probably monitoring tools. You've seen Chainalysis and a few others get out there, and I think that doing that for big banks is going to be a very large business. I think that as the banks and institutions start coming into the sector, less so from a trading side and more from a instant settlement on the banking infrastructure side, they're going to need tools that don't just monitor blockchains. They're going to need tools that monitor their existing assets and blockchains. Because just like AI in cars isn't a light switch where we've got autonomous vehicles that suddenly are on the road. No, we've got, we've got cars that can parallel park, and that's all they can do. And they've got these cameras in the back and look ahead and they make noise when you're going out of the lane. And slowly and surely, you start to have these features come in, and I think that's the same thing that'll happen in the banking infrastructure. And no matter which protocols are successful, you're going to need some of these companies to be there throughout the life cycle. And I think those will be the ones that we invest into.
Excellent. Thank you, Chris, for your question. We appreciate it.
And I think we have one more question as well from another person who participated in the NYCQ offering. So we'd love to have you introduce yourself and hear what that question is as well.
Yeah, hi. I'm Peter. I'm from Australia. It's about 5 minutes to midnight here, so
thanks for taking the time.
Yeah, pretty late. I did have a question, but Rob sort of beat me to the punch there about basically around the investment strategy. I mean, we know it's been well established that it's around security token infrastructure, but I think I'll extend on that and just ask probably Nikhil about how do you establish position sizing? What do you prioritize? I mean, obviously, you put a lot of faith into the project teams and also, I guess, what sort of problem they're trying to solve. But going a little bit deeper, do you employ any sort of robust financial modeling? I mean, Atit spoke earlier about like quant metrics and the like, but that would be kind of hard to do for private earlier stage ventures. Can you just maybe elaborate on that, how you would model out these potential investments and how you would position the fund accordingly?
Yeah, absolutely. So, I've fortunately been able to help manage a number of funds through SoftBank and Vast Ventures in my career. And cash on cash returns, I think, is the most important metric that LPs really care about. What we think about in terms of sizing is probably different than the typical structure of a venture fund. A typical structure of a venture fund is looking for 1 or 2 home runs and 3 or 4 doubles and then a bunch of failures, right? I don't think we have to be that binary for this structure. What we're really looking for is some companies we think could be absolutely great, but because we have the flexibility to invest in equity and tokens that are like equity, we can get a much higher degree of liquidity. And with that additional liquidity, maybe we can invest in companies that have a little bit less risk, right? Because we're able to get out early. We're not as reliant on a large exit at the end. We can sell into potentially the open market at any given time post the minimum holding period. So when I think about size, I'd like to have 4 to 10 investments in the portfolio. They can be as small as, let's call it a few $100K, to think we internally have decided a relative upper limit that could be in 20 to 30% of the fund. We like to leave a little bit of flexibility. I didn't give you specific caps and specific mins intentionally, because the greatest metric that most VCs fail to live up to is how much money did you put into your winners? And if that number, I think we did an analysis at CoVenture, and my colleague is completely going to call me off for being off by 1% on this. But I think the average for venture capitalists in America to put the amount of capital they have as a percentage of their overall holdings into their biggest winner is capped at something like 15%, right? And that's a failure on behalf of those managers. If you have an Uber, if you have whatever it is on your hands, yes, there's going to be a lot of competition to get in, but that's your most proprietary deal flow that you can ever have. You're in the company. You have literal rights to invest in. You get the updates in the company. You should be paying attention to everything they do. And the only way you can do that is if you have a relatively concentrated portfolio, you work really hard with those companies, and you position yourself as most favored nation, as follow-on rights, and hopefully you can put up to, if I found the best company possible, I'd put the entire fund into it, among whatever we have left, but you have to have extreme amount of conviction on those. You only do that once, and you do that with an extremely high amount of conviction. That's not something you throw around lightly.
Yeah, and I'll echo what Nikhil says, and that's flexibility in the portfolio, I think, is one of the most important things. I've seen venture capitalists shoehorn themselves into an investment thesis or shoehorn themselves into minimums and maximums, and it's hurt their return at the end of the day. So what's important is to bring in great managers like Nikhil and Atit that understand venture markets, that understand crypto markets, and allowing them to do what they do best, which is deploy this capital into these markets and do it with a high level of conviction.
Well, and one of the biggest points, Peter, is that markets are dynamic, particularly the venture capital market. That's the whole point, right? We're investing in innovation, and innovation, by its very nature, is going to be most successful when it is dynamic and when it's taking advantage of changes to the nature of where that innovation is occurring, what industries, what sectors, what geographies. And so, one of the great things about the city block model is we can create a diversified team of specialists by geography, by sector, and you as an investor can customize your portfolio to take advantage of where you see opportunity and where you see things moving. And that way, each manager doesn't have to get shoehorned into being too diversified. And as Nikhil said, you can really back that winner and ride that winner to better returns, which is in the institutional investing world that I came from and am migrating, to merge the two together. That's one of the biggest failings is people get over diversified and don't put enough capital in those things that they really care about where they have conviction.